Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now today, we're zeroing in on the precious metals market, where recent moves in gold, silver, and platinum group metals are catching the attention of investors worldwide, with gold adding significantly to central bank reserves around the globe, and with prices of gold reaching new record highs back in December 2023. The strategic move behind these central bank acquisitions are worth a closer look. Now, silver, known for its industrial and investment appeal, and platinum group metals, crucial in tech and green solutions, are also in the spotlight. And we're here to unpack them. And to guide us through this discussion, we're joined by Jeff Christian, managing partner at CPM Group, whose expertise, of course, and straightforward analysis has made you one to go to. Jeff, thanks for being on the show with me today.
It's good to be on the show, and it's good to meet you and do an inaugural interview with you.
I like it. Well, we have lots to get to. So let's start with gold here. We were talking a little bit off camera, but central banks globally have significantly ramped up their gold holdings, reaching levels not seen in decades, while economic fluctuations continue to influence investor sentiment towards gold. So I'm curious, how do these developments impact the valuation models? And might we be witnessing a shift in its long-standing role as a financial safe haven, or is there more to it here?
Well, in 2020, in the year 2000, November 2000, CPM Group issued a gold buy recommendation for investors. And we talked about what we called the gold renaissance, the idea that investors were rediscovering gold and would continue to buy more gold for a longer period of time than they had historically, because the economic and political environment, not for 1 or 2 years, which was the historical norm up to that time, but for decades, the economic environment would be hostile. And so we said that we thought that investors would be buying abnormally large amounts of gold going forward for decades, and that central banks would join them at some point. Investors started buying, there was an upward shift in the investment demand curve around 2001, 2002, and investors have bought historically large volumes of gold ever since then. And they're picking up their demand now. We expect it to rise this year compared to last year, and even more in 2025. Central banks started buying on a net basis around 2008, and that represented a confluence of two things. One was that those industrial nations that had a lot of their monetary reserves in gold, like 80, 90, 95% of their monetary reserves in gold, as a remnant of the old Bretton Woods dollar gold standard, international trade settlement standards, they would be disgorging gold, and most of that gold that they had wanted to sell, they had sold by 2005, 2007. While other central banks, China, Russia, India, other South Asian and Southeast Asian and East Asian nations that had not been major trading entities prior to 1971, when gold was used for international trade and capital settlements, they had 80, 90, 95% of their reserves in currencies, mostly US dollars. And they were diversified away from the dollars, just as the others had been diversifying their portfolio away from gold. And so what we've seen since 2008 is that central banks have been buying more gold consistently for a long period of time. Now, it's only about 22 central banks that are currently buying gold for addition to their monetary reserves in the last couple of years, out of 180 some odd central banks. But it is a significant increase, or as the Chinese People's Bank of China said in 2015, it's a small but significant change in our gold policy.
Yeah. And I mean, China's continuous gold buying and increasing its reserves significantly, I think that they're making records here, and it's sparking discussions about the US dollar's role in global trade. I mean, we talked a little bit about this. How might China's actions and the potential for other nations to follow suit affect the dollar's dominance as the world's primary currency here?
Well, there are a couple issues there. First off, China is buying a lot of gold. They have been buying a lot of gold since around 2009. It was after the great recession and the global financial crisis that the People's Bank of China started adding gold to their monetary reserves for the first time in a long time, decades. And they've continued to do that. They haven't bought as much as some people think because the data is mostly secretive, but they have been buying. And last year, they bought 7 million ounces. Central banks as a group, as I said, there were about 20 or 21 central banks that bought gold last year. And in total, on a gross basis, they bought about 18 million ounces of gold, and 7 million ounces of that was bought by the People's Bank of China. So yeah, they are the dominant buyer there. So you see banks, central banks, adding gold to their reserves, but the reserves, with the exception of, say, Russia, Uzbekistan, Kazakhstan, Venezuela, the reserves, their gold reserves are a very small percentage of their monetary reserves. Overall, it's about 15% of central bank monetary reserves are gold. And if you look at China, it's about 3%. So they have a long way to go. And again, that 15% reflects the fact that you have a lot of old industrialized nations that had acquired gold during the Bretton Woods dollar gold standard period that still have 50% of their monetary reserves in gold, or in the case of the United States, virtually all of it because of it. So that's the gold situation. Now with the dollar, it's something completely different. And the gold promoters don't necessarily understand that. But central bank foreign exchange reserves have been about 58 to 62% of those foreign exchange reserves have been in US dollars for decades, 30, 40 years. That's continuing to be the case. Central banks would like to diversify away from the dollar. They would like to have a multipolar international currency system. They would like to have more other currencies in their portfolio, but they understand that the reality of international economics is such that the dollar has hegemonic qualities that are not going to go away anytime soon. So for 20 or 30 years, you've had central banks saying, we'd like to diversify our foreign exchange reserves away from the dollar, but they really haven't. In the meantime, there's now been a shift in the theories that you hear central bankers talking about, where they say, the dollar actually may continue to be the reserve currency of choice for decades to come. And the reasons for that is that you've seen this persistence in the dollar's dominance in foreign exchange reserves. But you look at where you're going to put your money. What are you going to invest in if you want to consider monetary reserves an investment? And the reality is that the dollar has been much stronger than other currencies. The U.S. economy has a lot more going for it than its competition. So for you to say, let me get rid of my dollars, which have been rising in value, and replace them with euros or yen or Swiss franc or pound sterling, other liquid currencies that have been falling in value and have a long-term strategic disadvantage to the U.S. economy, doesn't make sense. So you're starting to see central banks, institutional investors, sovereign wealth funds, and others reevaluate their concept that they should diversify away from the dollar.
Interesting. I mean, how is this impacting international business being conducted? I mean, we've seen BRICS, we've seen some of these organizations start to continue to thrive. So I'm curious, what's your forecast here for the next year, considering we got all these geopolitical situations? We're in an election year. I mean, I could go on.
The political issues are very problematic for this year, next year, and possibly on a longer term basis. It's it's our biggest concern, are the political issues as opposed to the economic issues. We do think that we'll see an economic slowdown and possibly a recession in the United States late this year into next year. We're seeing recessionary conditions in the UK and in Japan now, and you're seeing signs of weaker growth really in almost every major currency world, so that's there. The BRICS are being used as a pummel by gold promoters. And if you look at the BRICS, let's just talk about those 5 countries. China has a policy. The gold in China stays in China. we don't want to use our gold for international trade settlements. If you want to pay for your imports of Chinese goods by giving us gold, we'll consider it. But we're not going to use our gold for international trade settlements. So, i.e. Russia, if we're buying oil and gas from you, we're going to pay for it in currencies, not in gold. India had been selling its gold for a while, the Reserve Bank of India, but they've reversed that and they've actually been adding to their gold reserves, partly because of long-term economic and international political uncertainties that they're looking at. So they will not use their gold for settlements purposes. And frankly, they don't even have rupees. Russia has proposed to India that they could use rupees to settle their oil imports. And the Reserve Bank of India said, we don't have a big enough float of Indian rupees to pay for our oil imports. There was one private oil company that imported like 1 million barrels of oil, a minuscule amount of oil, of India's oil imports in the third quarter of last year, and they paid for it with rupees. But it wasn't the government doing that, and the government actually was probably looking askance at it because it was draining rupee reserves from circulation. South Africa and Brazil, they each have about 4 or 5 or 6 million ounces of gold. It's inconsequential in terms of their trade volumes. They can't really use that gold for international settlements, and they don't want to. Russia, Putin has been talking about, well, let's use gold for international trade settlements. Let's have a gold pegged currency. But the central bank of Russia hasn't been talking about that. That's Putin's pipe dream. So you hear these gold promoters talk about a gold-backed BRICS currency. It's nonsense. It just doesn't exist. And anybody who says that it does is just talking his book.
Right. So the U.S. dollar is going nowhere, but you do somewhat see, according to the data, possibly recessionary impact here in 2024.
We have been talking about a recession in 2024, 2025 for several years, like since 2021 probably. And we have moderated our expectations. We think that there still will be a recession, but it will be perhaps shallower and shorter than we had been expecting. And it might be more of a rolling recession through the industrialized world. Obviously, it will have an impact on emerging economies, China, India, and other countries that export into the industrialized world. We're not believers in a soft landing. We think that a soft landing is a prolongation of an expansion period leading into the next recession. So we see weaker economic conditions on the horizon, and we think that at some point we probably will roll over into a recession, but it may be a lot more modest recession than we have been thinking for several years.
Wow, that's good news for a lot of people. Jeff, you mentioned the industrial uses here, and industrial demand for silver surges, particularly for use in solar panels, other green technologies. We're concurrently observing a tightening in the physical silver supply, though. So what are the implications of this demand-supply imbalance and for the silver market particularly, especially in terms of pricing and possible investment strategies looking forward?
Well, I think, first off, you've seen the role of increased silver use in electronics, in automotive electronics, in solar panels. You've seen that have an effect on the price in that the price of silver has basically stayed above $22 for most of the last couple of years. It would be lower than that, but for the fact that these uses are using more silver. What we've seen is that during that period of time, the last 2 years, you've seen an incremental decrease in investment demand for silver. Investors are backing away from buying as much silver 2022, 2023, and that's continuing in the first 2 months of 2024. And that's much more worrisome. If it weren't for that fabrication demand, the price of silver would be much lower at this point.
Interesting. I mean, is there an anticipation of a market correction then, or are we going to see this diversification in demand sources for silver continue to expand?
Well, I think that's going to continue that way. Solar panel growth is growing. One of the things that we saw a large surge in silver use in solar panels last year, maybe from about 130 million ounces to about 200 million ounces, or a little bit less than 200 million ounces. And a third of that increase apparently represents over construction, over manufacturing of solar panels. So there's a large inventory of manufactured solar panels that were made last year that have gone unsold. That will weigh on new use, demand for silver for the use in manufacturing new panels until those inventories are drawn down. On a long-term basis, we're bullish on silver use in solar panels, and we think it's going to continue to grow. But it's not going to be 600 or 800 million ounces the way some silver promoters and true believers think. It's going to be 200 or maybe 300 million ounces. And on top of that, you are now getting to the point where you're starting to see recycling of end-of-life solar panels and the recovery of silver. So as a historical precedent in the 70s and 80s into the 90s, photography was the major use of silver. There's about 250 million ounces of silver that was used in photographic products every year. But about 150 million ounces were recovered and recycled from spent chemicals, papers, and films. So the net demand or the net requirement for new silver in the photo industry every year was 100 million ounces. When photos started going away and being replaced by digital imaging, people were concerned, we're going to lose 25% or a third of fabrication demand. But in fact, we were losing 100 million ounces of, or 1/7, of fabrication demand. And you'll see the same sort of thing. You'll continue to see silver use in solar panels rise, but the rate of increase in the demand for additional silver will slow because of the reflow of silver being recycled from solar panels.
Yeah, so interesting recycling of gold as well, an increase in recycling of that metal. We were talking demand. The demand landscape for PGMs is evolving, influenced by the automotive industry, shift towards the EVs and the potential for platinum and palladium in new applications such as hydrogen fuel cells, even though we're seeing that market somewhat diminish. So what does this mean for PGMs? Are we at the threshold of a significant market shift here? Where are we at?
Well, there is a shift, and we're already in it. You'll have about 12 or 13% of the automobiles, light-duty vehicles, being manufactured and bought globally electric now. So you've already lost 12% of the light-duty vehicle market for internal combustion engines using petroleum products, and thus platinum, palladium, and rhodium used to clean up the exhaust of that. Now, going forward, there are headwinds to the electric vehicle industry. There are technical ones, there are logistical ones, there's supply ones, there's capital ones, there's legislative ones, and there's consumer resistance. And you're starting to see that consumer resistance start to pick up and become more of a headwind. So you've seen a slowing in the growth and demand for electric vehicles. Our expectation is that by the year 2050, so a quarter of a century from now, you will still have about 50% of the vehicles either burning petrol, gasoline, or diesel, or hybrid. So they'll still be using catalytic converters. They'll still be using platinum, palladium, and rhodium to clean that exhaust. So we see a diminished role for PGMs and a diminished demand in the auto sector over the next 25 years. But we also see a continued need for that. And I think investors have gotten ahead of themselves. They were thinking that you'd have 50% of the vehicles, electric vehicles by 2030 and 100% by 2035, and you wouldn't need any PGMs. So there's been a paucity of investment in PGM mining capacity. And that's going to come home and bite the auto industry because the supply of PGMs probably decreased sooner and faster and further than the demand from the auto industry.
Interesting. I mean, considering the cyclical nature of commodity markets, could emerging technologies or maybe some unforeseen sectors emerge as a new demand vector for PGMs?
I didn't put you up for that. Let the viewers know. I didn't put you up for that. We're watching hydrogen engines, and Toyota recently, late last year, unveiled an 8-cylinder hydrogen engine. Hydrogen engines could change everything. They are half as expensive to build and maintain as internal combustion engines that burn petroleum products. They are 15% as expensive as a battery pack for an automobile, and they're about 7% as expensive as a fuel cell, and they're much more reliable. So if you can get hydrogen safely and cheaply distributed, shipped, stored, and distributed, the auto industry will switch to hydrogen engines. At BMW, Toyota, Ford, and a number of other companies have been looking at hydrogen engine technology for years. The technology's there. What needs to be developed is liquid organic hydrogen carriers, which is a cheap and safe way to ship, store, and distribute hydrogen. Once you've got that, the platinum industry wants you to believe that everybody will switch to fuel cells. But the auto industry says, no, we'll switch to hydrogen engines because they're cheaper. We shave $2,000 off of the cost of manufacturing an automobile if it has a hydrogen engine as opposed to an ICE engine that burns petroleum products.
Interesting. Yet we see these hydrogen fueling stations across the U.S. kind of being shut down. So is it more of a commercial use right now? Are we a little bit too fast to the market as consumers on this hydrogen technology?
Well, in terms of fuel cells, yes, and we think that fuel cells make sense for fleets. So intra-city buses and airport tarmac equipment, places where you have a fleet manager and you can have the hydrogen there. There were a couple major retailers who tried to use hydrogen fuel cells for their forklifts in their warehouses. And the insurance companies sort of shut them down. And the arc is very telling, because what happened was they started buying these fuel cell vehicles. And first off, the stacks weren't lasting as long as they needed to. So you had technicians there pretty much all the time. But you had these tanks of liquid or compressed hydrogen built and put behind chain link fences and barriers on the parking lot of these warehouses. And the warehouse managers asked for a significant amount of money to be invested in secondary and tertiary power supply, backup supply. And, chief financial officer said, why? And they said, well, we have these compressed hydrogen tanks on our parking lot. And if the power goes out, we have to keep those things compressed or we have a real problem. Right. So the CFO and the C-squad, started looking at, do we do this? And the insurance company came along and said, the answer is no. You want your warehouse to be insured. You don't put hydrogen tanks on the parking lot. So there are headwinds there, but we think that fuel cells have use stationary applications and fleet applications in intracity and airports and specialized places like that. We don't see fuel cells being viable for light duty vehicles that are used on road. So on-road transportation, we don't see fuel cells as being viable. It really comes down to the liquid organic hydrogen carriers, and people are trying to find ones that are competitive and that can carry enough hydrogen to be effective. We found one company that has such chemicals, liquid organic hydrogen carriers that can handle 5% or more hydrogen carrying. That would radically speed the transition to hydrogen engines, because you can use existing fuel distribution systems, pipelines, trucks, train cars, storage tanks, filling stations. You can use the existing infrastructure with liquid organic hydrogen carriers to supply hydrogen, as opposed to spending, I think it's $2 million or $3 million each for a hydrogen filling station in California.
Yeah, fascinating market to follow. I'm excited to get you on to talk a little bit more about that. But before we let you go, let's zoom out a little bit, looking across the spectrum of precious metals, considering current market trends. Then, of course, as we mentioned, we have the technological advancements and economic indicators. What strategies are you recommending to investors aiming to leverage opportunities or maybe hedge against risks in the precious metals market here? Are there any specific indicators or metrics that we should be paying closer attention to?
Well, our expectations are that gold and silver prices will rise sharply over the next 2 years. And so our investors, high net worth individuals and institutional investors, sovereign wealth funds, they are long-term investors. So what we are doing with them is we're sort of gearing them up and saying, okay, let's assume that CPM Group continues to be right in its price projections and gold and silver prices rise sharply over the next 2 years. At some point, they will peak, and you should do one of two things. If you want to, you should sell your gold and silver at that point, and you might be able to buy it back soon after at a lower price. Or if you want to continue to hold your gold and silver, which is what we advise them to do, you should buy puts at that point and maybe pay for those puts with a call spread. And then we price and structure and show them how to do that so that you maintain your physical ownership. But if the price does peak and fall back, you profit on what is in fact a hedge on your metal. And producers can do this. Producers did it very effectively in the 80s and 90s. They backed away for a lot of bad reasons. But producers can do it. Investors still do it.
Interesting. So no ETFs then. Hey, Jeff?
One of the things that we didn't talk about, which is interesting, is, ETFs are publicly listed. So you have a daily reckoning of how much ETFs have been adding to their gold stocks or selling. And like last year, you had about 6 million ounces of gold ETFs sold, but you had about 24 million ounces of bullion, coins and bars bought by investors. But that's all secretive. Investors don't say, oh, I just bought 24 million ounces of gold. But ETF data is available. So people looking at the gold market say, oh, investors sold 6 million ounces of gold last year. But in fact, they bought on a net basis, including that 6 million ounces of ETF sales, they bought 24 million ounces. So investment demand is still very strong for gold. But what we're seeing is a shift away from ETFs to bullion. And that doesn't necessarily reflect bearishness toward gold. What it reflects is worries about financial market counterparty risk. I want to own physical gold, given the state of the world. I don't want to own shares in an offshore company that is managed by this bank and administered by this bank and serviced by these other banks. I want to get rid of my counterparty risk in the terms of financial intermediaries. I want to own gold directly. So that's a trend that started to emerge in 2022, picked up in 2023, gold and silver, and probably will continue in 2024.
Yeah, makes sense. I mean, like you said, it's a little bit secretive too. You don't have to know who's holding what and who's got what position. Interesting, the gold market, always. Jeffrey Christian, managing partner at CPM Group, joining us today to break it all down. Hey, Jeff, thanks for coming on. This has been fascinating. I'm especially curious about these ETF numbers. I'm going to go look at the outflows now.
I'll send it to you.
You betcha. Thank you so much. And thank you for watching. Don't forget to subscribe to our YouTube channel and go to kitco.com for all your breaking news. We'll see you next time.